to Let's Talk Real Estate Investing. In this podcast, I bring you insights, experiences, and lessons from real estate investing professionals at all stages of their journey, along with industry experts who provide essential services to you to help you to succeed. Our goal is to empower you with the knowledge and strategies needed to build a personalized real estate investing plan that aligns with your unique goals. If you enjoyed this episode, please hit that like button and subscribe to my channel. It helps me to continue to share valuable content with you. My name is Debbie Balfour, and I'm a real estate investing professional and a real estate investing success coach. Real estate investing isn't a one-size-fits-all. Your strategy should be unique as you are. Today's guest has worn many hats over the years, from professional cooking to campus security, and now he's helping others rethink their mortgage strategy. He lives in Calgary, and he's lived there for 35 years, spent over 3 decades officiating basketball, including 25 years with wheelchair basketball, and now works in the lending space. He's passionate about helping people make smarter financial decisions, and we all need that. He is a mortgage broker, but he's also a real estate investor with about 22 years plus of real estate investing below his belt. His topic today is about don't just renew, rethink. Because when it comes to mortgage renewals, there's so much more at stake than just signing that piece of paper. We're diving into how the options you choose or don't choose can seriously impact your long-term wealth goals. So let's get into it. Before we go any further, I'd like Keith to introduce himself and tell us a little bit more about himself and his journey in real estate. Over to you, Keith.
Hey, thank you, Debbie. A pleasure to be here. Thank you for inviting me on to have this very important discussion with you. I've been a mortgage broker for 10 years now, coming up on 10 years. And in that time, so much has changed. I've been a real estate investor, as you said, for just over 22 years now. That landscape has changed, but the landscape in the lending world is just changing. It seems constantly. What you could do 5 years ago is not what you could do 10 years ago, and what you can do this year is not what you could do last year. And this is all part of, to me, what's such important knowledge that I need to continually grow and learn to be able to help my clients be able to make informed decisions. So, as much as I love to be able to go and referee wheelchair basketball, I love that community and be able to do that. I've met some fantastic people there, and have become good friends. Investing in real estate has been a passion for many, many years. And that was, when we bought the first condo was bought for family to live in so that they could make ends meet. And from there it grew. That's when I then discovered the Smith maneuver. Back in 2004, I read the book, implemented that in 2005, converted our mortgage under the Smith maneuver over 2 years, doing a flip property, buying buy and hold. And 20 years later, it's still given benefit. It's all this stuff comes together and helps me piece together each person's story as they tell it so that I can ensure that they're making informed decisions and that they get to see the opportunities. My personal vision is that all people are living a life of opportunity. And through these conversations, I hope that I get to impact them in a way that they do as well. Because in this environment that we have right now, when it comes to mortgages, we just need to stay calm and mortgage on.
So tell me, Keith, you said Smith maneuver. What is the Smith maneuver and what does it have to do with mortgages?
Well, the Smith maneuver was originally created by Fraser Smith back in the late 80s and early 90s in conjunction with Van City. They created the first re-advanceable mortgage. And the purpose of that was to allow the everyday Canadian to take advantage of the deductible interest from funds borrowed to invest in unregistered investments. The wealthy have done it for decades, but the everyday Canadian typically did not have access to or did not have the ability to have the extra funds to be able to do that. So the Smith maneuver in the basic form is to be able to convert non-deductible mortgage interest on your primary home into deductible interest on your home by using the equity that you pay down on your mortgage to then take and put into unregistered investments to build wealth, as well as create tax deductible interest at the same time and exponentially increase your future bucket of funds for your retirement. It requires a mindset shift by most people. Some people not, certainly they get it. Other people do not, because for years, not even years, for decades, your parents, your grandparents, your aunts, uncles, cousins, friends that you have, myself as well, and for most investors, they've always been told you buy a home, you get a mortgage, you pay it off, you live in the home, and you hope that you have enough in retirement pensions and things coming in that you can afford to still live in your home. Well, what do we know is happening for a fact is that people can't do that. And so what do they do? They have this home that's paid off. So what do? They go and get a reverse mortgage to be able to afford to live in their home. So why is it that as Canadians, we're okay with paying off a mortgage and then using our home to go and live off of in our retirement? So borrowing against our home to live off in retirement, rather than during our formidable earning years, using that asset, which is our primary home, to help build wealth exponentially so that we have a larger pool of money here for our retirement. And if we so choose, and we still have money owing on our mortgage, we could actually pull out from that, pay off the mortgage, and still have a pool of extra money here that we can use to live off of in retirement and have our home free and clear. So it's a mindset shift of not thinking of your home as purely having a mortgage to be paid off and to be mortgage free on your home, because the reality is Canadian pension plans not keeping up. OAS isn't keeping up. Most private or public sector pension plans aren't enough to support the monthly cost of living. Some people who are able to make ends meet, that's all they're able to do is make ends meet. They don't have the ability, if their kids or grandkids live away, they struggle to be able to go and see them because they don't have the money to, if they need to fly. They don't get to go and enjoy vacations because they struggle with only the pensions that they have coming in not being what they thought they would, and the general cost of living being higher, with utilities going up, insurance going up, property taxes going up. These all continue to eat away at a greater pace than what pension plan incomes are going up at. And so this is why that mindset shift is so important, and where the Smith maneuver in its basic form can help everyday Canadians. In the more advanced form for real estate investors, it can help them to be able to buy investment real estate, generate tax deductions through interest if they borrow from equity for a down payment, or if they already own real estate, getting set up so that they can flow the income from their rentals that they need to cover expenses through their mortgage, back from the line of credit into the rental property to cover those expenses, thus helping accelerate the conversion with what the term is called cash down,
Right.
which is what is not commonly known. So those are ways. And then there's other things that can be done to help accelerate, but it doesn't have to only be done with real estate. I think you would agree with me that diversification in any investing is important.
Yes.
And so if we put all of our eggs into only one basket, whether it be real estate or unregistered funds or RSPs or TFSAs, whatever it is, we're doing ourselves a disservice of hedging our future wealth. The Smith maneuver is just another strategy that gives you a tax advantage. If you're in a 40% tax bracket and you get to the point where you can deduct $10,000 of interest in a year, 40% of $10,000, that's a $4,000 tax savings each year.
Yes.
And most people can't get to there right off the bat, but there are people who can. They just don't even know how they could actually accelerate their ability to convert their mortgage to be tax deductible, their interest on their mortgage to be tax deductible. And that's the piece that to me is so critical.
So Keith, let's break it down so we can make it pretty simple, because I totally understand this. But for people that don't, say my mom gave me $10,000, and and I could either pay down my mortgage, right, or do I invest it in some in stocks or something like that, or real estate, whatever? What would that look like as a Smith maneuver?
Well, as a Smith maneuver, and this is a great point you bring up, because the transfer of wealth that's going on now and for the next probably 10 years is huge. So 10,000 is a very, it's a very small example, but it gives us the chance to represent. You can achieve both if you use the Smith maneuver in the right way, and your mortgage is set up with a proper re-advanceable mortgage. You would take that $10,000, pay down the principal on your mortgage. The line of credit that you have connected to it would increase by $10,000. You pull the $10,000 from the line of credit, put it into the unregistered investments that you were looking to. Now the interest on that $10,000, it's been converted from a term mortgage to the line of credit, but now the interest is 100% tax deductible on that $10,000.
Now you're also on the mortgage side. You've just reduced your
non-deductible mortgage amount by $10,000. You still, if you started out before you did it, if you owed $300,000, you still owe $300,000. It's just now you have $290,000 here and $10,000 here. Now, as you make payments on your mortgage term portion, each following month you'll pay more to the principal, so you'll have more available to invest over here. So this will start to increase even faster. $1,000 can still have a great impact, absolutely, if you're implementing the strategy and you're working with Smith Maneuver certified professionals in the mortgage, the accounting, and the investment world, so that they know what you're doing, so that you're getting the proper guidance.
Right.
And without having the proper guidance, things can go very wrong. And that is where problems start to occur, whether it be investing in the wrong products and then getting audited by the CRA and getting clawed back, or by investing in the wrong products and suffering losses that could have been mitigated had you just sought the guidance of the right professional.
Right.
Funnel it, have the right guidance. So maybe there's a debt swap available at the beginning that can help accelerate that conversion of some or all. There's many parts and pieces, and that's why each person's situation is unique to them. And that's why it's not a one-size-fits-all solution that we put together for each person's Smith maneuver setup. Each one is their own. Some people are starting just plain basic. They don't have extra cash to put down. They're just starting. Their plan is they're going to start doing it from the pay down on their mortgage principal in month one. It's going to be $900 a month for the foreseeable future. And so it's going to take them longer, but they're starting to build wealth as well. Some people just start that plain and simple, and that's okay. There's nothing wrong with that. At least you're taking action to build a better future for yourself by design rather than by default.
Is a re-advanceable mortgage available at any?
No. Well, most of the major banks have a version of a re-advanceable mortgage. They don't all work the same in how they are set up. And that's very critical to know. Some are not great at using to implement the Smith maneuver. It can be because of delays in your principal pay down showing up in the line of credit. Some have like a 30-day delay. Some might have a 10-day delay. That can be an issue. Some require you to have a minimum line of credit paid, or a minimum principal pay down of $10,000 before you can start using the re-advanceable line of credit. So there's things like that. Some don't have proper way to do tracking accounts. Some don't allow you to pay interest on the line of credit that you've used from the line of credit, whereas others will. So there's many nuances in this realm of re-advanceable mortgages. So not all re-advanceable mortgages are the same when you dig into them. On the surface, yes, it's a mortgage term connected with a HELOC. that works together. But when you dig in, not all are the same.
What do borrowers need to consider at the time of mortgage renewal?
So at mortgage renewal, there's really 5 options that borrowers have. And most borrowers don't know that that there's 5 options they should consider. So option 1, they can just renew their mortgage with their current lender. So that's your mortgage balance remains the same, your amortization remains the same. Maybe you can negotiate the rate, but your payment will be higher because your amortization is whatever is remaining on it. So that's number 1. That's the most simple and basic. The second option is, you can transfer that mortgage over to a different lender. So the mortgage balance could remain the same, and the mortgage balance will remain the same. The amortization can remain the same. However, there could be better rate options or better terms for the same rate, or maybe even better terms for a slightly higher rate. So this is where understanding the different terms in a mortgage, not just looking at rate, become important. Big one being mortgage payout penalties. You ever had to pay off a mortgage early?
Yes, I've done that.
And were you ever shocked by the payout amount?
Yes.
Yeah, me too. So understanding the terms, and especially something like payout penalties, is critical, because the banks have the highest payout penalties because they use what's called a discounted interest rate differential penalty calculator. So it makes their penalties 3 to 4 times higher than other lenders that just use a actual posted rate calculation for penalties. Well, the reality is people who take a 5-year term, they go, I'm not going to touch it in 5 years. But over 30% of people break it at about the 3-year mark. So things happen. As much as we try to predict our life for 5 years, we can't always do that. Things happen. Divorce happens, death happens, joint venture partnerships break up, employment losses happen, having to relocations, whatever. Kids go to university, kids get born. All these things can happen that initiate the need to make a change to the mortgage. So really understanding those terms are important. Now, because we mentioned the Smith maneuver, another important term is, what are the lump sum, what are the prepayment privileges you get? Many of the banks are now, they'll offer low rates, but they'll limit you to like 10% annual and 10% monthly on your prepayment privileges. Some offer double up, not all of them, but those are things that can get investors and any borrower that's borrowing a mortgage hung up during a 5-year term. So this is important. That's an important one. So that second option is, you can transfer to a new lender that's going to offer you better terms, maybe a similar rate or a better rate, or maybe even a slightly higher rate, but better terms that in the long run will save you well. Third one is, we can do that same transfer, but we can re-amortize the mortgage up to 25 or 30 years, depending on the type of, if it's an insured mortgage that somebody has, we can re-amortize it. Look to re-amortize that mortgage up to 25 or 30 years. For investors, to give an example on this, if it was a primary home previously that you had a high ratio insured mortgage on, now you've moved from it, you kept that mortgage and it's a rental, because it's still an insured mortgage, you can still actually do a transfer. You don't have to do it as a refinance. There are lenders that will accept that as a transfer.
Okay.
And allow you to re-amortize, which will bring down your payment, which increases your cash flow, because cash is king.
Yep.
So that is a way that one helps. The fourth one is doing that same transfer, leaving the amortization the same or increasing the amortization, but also being able to add a separate line of credit. Now, this is not a line of credit that's interconnected with the term mortgage as a re-advanceable mortgage would be. It's a separate line of credit. But it could, in some cases, it gives somebody the ability to consolidate debt, access some equity maybe for investments or as an emergency backup fund. I've set them up for people for many different reasons. Some people they really want that lower rate that comes with transferring the mortgage, but they also want access to line of credit. They're not so concerned about implementing the Smith maneuver yet. They just want to they're kind of dipping their toes in with this line of credit to use for investing. No, they're not 100% sold on it yet. So that's the fourth option, right? To be able to do that. And then the fifth and final option is just doing a full refinance, which often applies to a lot of investment properties. Not all, there's a lot of people, they've refinanced the property before and it's a rental property and it doesn't fit the other categories. So their option is either sign the renewal or do a full refinance, reamortize to 25 or 30 years, get the best cash flow, the best terms possible, and be able to do a reset. I'm working with a client right now who own 5 rental properties, and their amortizations are all so super low on them, but their cash flow is not great because their amortizations are so low. And now with these mortgage rate increases for their renewals, their cash flow is going to look even less. So we're doing a reset for them on this. They need to do some repairs on properties and some renovations there. So we're doing a reconfiguration of what they've got going. Their employment has changed somewhat over the years. They're ready for a reset. So we're going to do a reset. We're going to get them set up so that they're maximizing cash flow, maximizing their being able to build their future wealth. We're going to get their primary set up on a re-advanceable mortgage so they can implement the Smith mover, doing a whole many things for them. But this is all triggered because they had one mortgage renewal coming up. We start talking about that one mortgage renewal, and now we're doing a reconfiguration of 5 properties.
In the past, you'd get a mortgage to purchase the home and then you pay it down. But now, as we get savvier with investing, with finances, etc., we want to look at that mortgage more as a lifestyle, financial freedom, because a lot of times that's the only asset we all have.
Well, the days of buying a home in majority of communities, there are still some where it exists, of buying a home for $120,000, living in it for your life. Now, yeah, there's some condos maybe in Edmonton and some other places where you can buy them maybe for around $100,000 or whatever. There's a whole nother risk around condos and condo fees and special assessment. That's not what we're here to talk about. Majority of people, when they're buying a home, they're investing now. It's the single largest investment they make with their down payment into a property. Even if it's 5% on $400,000, it's $20,000. They worked hard to save up that $20,000. If it's a rental property, it's 20% of that $400,000. So it's a big investment that we're making. And the average price of homes being now in Alberta, $500,000, $700,000.
See, and my home is not a mansion. It's 2,500 square feet. And it's worth 1.3 million.
There you go. So over a lifetime, if you're paying off a mortgage on that with 20% down, so now you can buy up to 1.5 million with as little as about 10% down. It's a little bit less than that if you want, but your lifetime cost of that is huge. So when you get to the point where you can start using the equity in your home to help build wealth so that you can maintain living in that home in retirement, just becomes a bigger consideration of thought and creating that financial life by design than you ever did before. Because what do most people do when they can afford a home? They end up buying at the maximum debt servicing that the bank will allow them to do. Great, but then what is there to build wealth outside of that?
There's nothing left of the paycheck.
Generally, nothing left on the paycheck, right? By the time you do some travel, if you have kids and you start paying for kids' sports and whatever, there's just nothing left at the end of every month to put into all with the best intentions, right? Well, we're going to put $250 a month into our RSPs or TFSA or whatever it is. But what's the first thing that gets when the crap hits the fan and you need money? Well, we're not going to do that $250 this month. And then, how many months do you end up skipping that $250?
Also, I think you were talking about that shift in mindset to understand that but it's also a shift in mindset to understand there's consumer debt and then there's investment debt. But it's okay, if that debt is actually going to earn you money, it's not how much you're paying, it's how much you're earning.
Exactly. And that's why having, a lot of people do go and do the unregistered investments on their own when they implement the Smith maneuver. I would say that majority of people are not savvy enough to do that. You need to be savvy enough to be able to read and have the knowledge to be able to go and open a Wealth Simple account or a Questrade account and be able to do that. Maybe if you're just looking to buy some blue chip stocks, maybe you can do that on your own to be able to make that happen. Or you're going to, invest in some private equity or something. You can, do that analysis and decide if it feels right. But when it comes to trying to do unregistered investments, to pick stocks or funds to invest in, it's worth the most financial advisors will have a complimentary conversation with you to help understand what your goals are and what types of things you should maybe consider investing in. It's just like me with a mortgage broker. I have many conversations with people who are just looking for information about, could the Smith maneuver be right for them, right? Can they even qualify for a mortgage? Doesn't mean that every person I talk to, I end up doing a mortgage for tomorrow. Sometimes it's 4 years later, they reach back out and they go, hey, we talked 4 years ago. We're ready now, right? We talked a year ago. We're ready now, whatever it happens to be. So sometimes it just takes people a while to, one, either be prepared, whether it's saving for down payment or the right employment being right, whatever it is. In other situations, it's time that it took them to gain the knowledge to then be comfortable to, now step ahead and step into the Smith.
There is caution that needs to be there. So it's exciting that you can take this and invest, but you've got to know that you got to pay back this money still. I've seen a lot of real estate investors that were trained that use the passive route of investing to use this money to passively invest, but invested in the wrong things. And they've taken like all of their line of credit and put it into things like a promissory note that's not even worth the piece of paper. And that person went bankrupt. People need to remember that you do have to pay that interest, at least the interest back every month on it. And the investment that you're doing, is it giving you cash flow? Can you pay that interest?
Yeah. And sometimes it takes, depending on what you've invested in and what the rate, the timing is for you to receive returns. Like there are some investments that you can go into that pay you monthly, quarterly, some semi-annually, some
at the end of 5 years.
Or some at the end of 5 years. The question you have to ask yourself is, well, one, can I take on that, can I
interest
handle
payment?
that interest payment? In other cases, it might be, because I'm going to receive monthly money annually, I have to be able to do it for the first year. And then when that rate of return if that rate of return was 8%, I can pull 4% out, or after I do my taxes and I see my tax return, maybe I then take my tax return and I use my tax return savings that I get, and I use that to help pay the interest that I now am paying on that line of credit each year or each month. Maybe, or it's a portion of the rate of return that you earned on the investment that you use a portion of that to do it. There's just, depending on your financial situation, will determine how you need to implement and set that up. There's ways to do it though, with the right guidance. Again, guidance is so critical. Guidance is super critical.
By working with, like you said, the right team, the right mortgage broker, the right accountant, the right financial advisor that can help you to structure all these things and make sure that you're making the right decision. It's not just the setting up of this re-advanceable, it's how you're using those funds.
Yes, 100%. 100%.
Excellent.
Yeah, it's super important. And that's why renewal, and that's why the idea of rethinking at renewal is so important. And it may not be that you're ready to implement the Smith maneuver at the time of renewal. because you want to learn more information about it. You want to dig in. You want to get yourself to where you'd be more comfortable doing it. That's fine. I have plenty of clients that come where we set them up with the proper re-advanceable mortgage because they want to get into the Smith maneuver and start doing it, but they're not ready just yet for any variety of reasons. Usually it's because they want more knowledge, but the timing is that, well, our mortgage renewal is coming up. And so we get them set up so that they'll be ready to.
So they have the flexibility to use it.
The flexibility to choose when to do it and not have to wait 3 years or 5 years down the road.
I didn't, until like 6 years ago, know anything about how to do anything with real estate investing. I wish I could turn the clock back and go back. But I did do right is I had set up my mortgage as a re-advanceable kind of thing. In case I needed this, I had it. I didn't know the benefits of it, but I had that there. So then when I learned about real estate investing, I had a huge limit now available that I went crazy. I was able to put down payments on 5 properties as a result of having that. But that was on luck side. I just happened to had that type of mortgage.
And luck is never truly luck. Luck is the result of preparation and action.
Right.
Right? You didn't know what you were preparing yourself, but you had set yourself
I
up.
wanted that flexibility to have that there.
And because you had done that, when the opportunity showed up, you were able to
I was making up for lost time, Keith.
But that's the thing. The whole idea of what, a line of credit, it's amazing how many Canadians don't know about the Smith maneuver and how many have a line of credit and a re-advanceable mortgage already and aren't using it the way that they could be. A lot of it because they think that it's only applicable to using it for real estate investing, which is not true. You can use it for real estate investing. Absolutely. That's an unregistered investment. But you can use it for stocks, segregated funds, mutual funds, GICs, T-bills, EFTs, or anything that's unregistered. You cannot use it for RSPs, TFSAs, or FAs, or the new first home savings account. You can't use it for those. Those are registered. You already get a tax benefit, but you can use it for private equities. I have several things that are in different private equities. Again, but a different level of risk that you have to be prepared to gain the knowledge on and make the decision on. Some people use their line of credit as passive investing by doing first and second mortgage for other people. That works too. There's nothing wrong. You can use it to invest in your own corporation and be able to take advantage of the Smith maneuver. That's a big one.
Yes.
And maybe I'll end with that last bit for this one, for the Smith maneuver with a corporation. And it can be that somebody needs to buy an $8,000 piece of equipment for their company. And so they go to talk to the bank about getting a loan for that $80,000 piece of equipment. And the loan is going to be in the neighborhood of 8 or 9%, typically at least 8%. But yet they're sitting on a bunch of equity in their home that they could get at near 4%, 4%. If it was a line of credit, near 5%. But because it can be put into the term, so near 4%. And they don't realize that it's all their debt. Even if it's in the corporation, it's still all their debt that they're responsible for in some way. They could go and get that $80,000 from their home, lend it to the corporation at 8% themselves, and make 4% back from their corporation themselves if they want, or put it into the corporation and only be paying 4% and only have the corporation cover the cost of what that actual is. But the interest now is 100% tax deductible on the personal side because the intent from a corporation is to earn a return on your money. And in this case, it's a piece of equipment, which is to help grow, to help the business. So it's amazing how little nuances of just things like that could make a huge. Would you rather pay 8% or would you rather pay 4%?
Definitely.
Right?
Yeah.
When possible. So it's things like that.
Quick, one more question before we wrap up is for re-advanceable mortgage, is it available for under business account? Under
a business account? You mean in a corporation?
In a corporation. If I've got my mortgages under a corporation, Can I get a re-advanceable under the
You can, just the lender options that are available that do lending in holding corporations for investment property is shrinking, it seems, every year. Lenders are dropping their policy of doing mortgages in a holding corporation. So that, because you have to personally guarantee that mortgage anyways, that's where sometimes getting into setting up beneficial trusts with your properties, financing them personally, then doing a beneficial trust with your accountant after is the way that you end up doing it. So you have access to more lender options. But the lender options for doing, yes, there are re-advanceable mortgage options, but the lender options for being able to do that in a holding company are shrinking. Now, that's a rental property. Your mortgage interest is already 100% tax deductible on the rental property. So it's not as critical. It's more critical on your primary home that you have that.
Yeah.
Properly do the Smith maneuver.
Amazing. So, Keith, you mentioned you had a freebie for
Yes.
our audience. What is it and how can they get it?
Yeah. So you're going to be sharing my contact information. If they reach out to me, I offer free Smith maneuver consultations to people and also free mortgage renewal discussions to review their options and strategies with them. There's no obligation. I just want to make sure that people are living a life of opportunity. And the only way I can do that is by having conversations to make sure that I share the knowledge I have so they can make informed decisions.
Excellent. We didn't dig into it, but a version of this, the Smith maneuver is for like your principal residence, but
Correct.
a version of this is called cash damming, that where rental income flows in and then back out. Yeah. So if you'd like to find out more about that too, please reach out to Keith and he can explain what cash damming is and how it can help you when you have rental properties and a mortgage on your home.
And part of that Smith maneuver offer includes some digital materials around the Smith maneuver that I share with the clients.
Okay, awesome. Well, thank you so much, Keith. Really appreciate you being here. So this is Keith Uthe, and Keith is a mortgage broker. He's located in Calgary, but you can help people across Canada, right?
Yeah, our brokerage has the ability to and licensing to do mortgages across Canada. So we're happy to be able to help clients throughout.
And real estate investors, you're always looking for that mortgage broker that understands you as a real estate investor. So Keith does. It's not just that he works with real estate investors, but he is a real estate investor himself. So he understands our goals, what we're trying to achieve, and what would be best for you. So please do reach out to him. For today, if you enjoy this podcast, please hit that like button and subscribe so that you can get notifications when more of these podcasts are dropped, usually on a Wednesday. We'll see you again on the next episode. For now, Debbie and Keith out.
Thanks, Debbie. It was a pleasure.
Thank you for being here.